In the first quarter of 2026, a sharp division emerged across global investment banks regarding how to position their operations in the Asia-Pacific region for the next decade. Morgan Stanley adopted a defensive posture, initiating cuts of roughly 3% to its global workforce. The explicit goal was to manage excess capacity left over from a period of aggressive pandemic-era hiring. To manage deal flow in Hong Kong without committing to long-term fixed costs, Morgan Stanley began hiring junior and mid-level staff on one-year contracts, an unusual move for a major Wall Street bank in the region. This chart shows the diverging headcount strategies of JPMorgan versus its bulge bracket peers in the Asia-Pacific region over a 12-month trailing period. While competitors focus on contraction, JPMorgan is committing to permanent senior expansion, adding more than a dozen managing directors across the region. The centerpiece of this expansion strategy is the acquisition of Yi Zhang, a 22-year veteran of Goldman Sachs, to co-head JPMorgan's China investment banking unit. For Goldman Sachs, this marks the second departure of a senior executive from its China operations in just 2 months, following the January retirement of Kai Wei. Zhang steps in alongside the continuing co-head, Michelle Wang. Wang brings deep local coverage relationships and a background in ECM. ECM stands for Equity Capital Markets, the division responsible for advising companies on raising capital through the stock market. By securing top-tier talent while rivals focus on expense management, JPMorgan is executing a calculated land grab for specialized human capital. To understand the timing of this talent war, we look to the Hong Kong Stock Exchange. The exchange has reclaimed its position as the world's top venue for the IPO. An IPO, or initial public offering, is the process of offering shares of a private corporation to the public in a new stock issuance. In 2025, the market saw 114 completed public offerings raise 286.3 billion Hong Kong dollars, doubling the total proceeds generated in 2024. The momentum accelerated into January 2026, which recorded the busiest month for listings in the exchange's history, propelled largely by massive stock offerings from mainland enterprises. This surge correlates with the return of international capital from Europe and the Middle East, drawn by a Hang Seng index that posted year-to-date gains of over 30%. This comparative chart displays global IPO rankings by funds raised in 2025, placing the Hong Kong exchange at number 1. This volume is supported by the A+H listing mechanism, allowing large companies listed in Shanghai and Shenzhen to access Hong Kong's US dollar-pegged liquidity. The capital has returned to the region. However, the profile of companies entering the pipeline is entirely different than in previous cycles, requiring a highly specialized caliber of banker to execute the deals. The old model of Chinese economic growth is dead. The domestic property sector, which historically contributed nearly 30% of the country's GDP, is now in a state of permanent structural contraction. In its place, the state engineered a replacement engine. The 15th five-year plan, covering 2026 to 2030, mandates a strict national focus on technological self-reliance. Analysts call this China Shock 2.0. It is a state-subsidized pivot into high-tech manufacturing that grants Chinese firms a 20 to 40% cost advantage over global competitors. This strategic shift deliberately reduces the import intensity of Chinese growth, while positioning the country as the dominant exporter in advanced sectors like robotics and semiconductors. The execution of China Shock 2.0 relies on automated precision. By scaling this high-tech manufacturing, the domestic industrial base undercuts global production costs. As a result, the Chinese economy is now powered by the world's largest installed robot base, driving a relentless cycle of efficiency. Based on this manufacturing surge, Goldman Sachs Research projected a 4.8% GDP growth rate for China in 2026, outperforming the consensus estimate. For Wall Street, the implication is clear. The lucrative deal pipeline is no longer driven by real estate debt. It is entirely dependent on industrial technology equity. We can see this policy shift directly in the current A-share IPO pipeline. A-shares refer to the stock of mainland China-based companies that trade on the 2 Chinese stock exchanges. This sectoral breakdown chart illustrates the pipeline. Industrials lead at 44%, followed by TMT at 22% and healthcare at 9%. TMT acts as the critical second pillar. Combined, 66% of deal flow now requires highly specific, advanced technological expertise. This includes mega deals from corporations like Ceres Group and CATL. CATL is Contemporary Amperex Technology Co., a leading Chinese battery manufacturer. Offerings of this scale prove the massive capital requirements of these strategic sectors. The composition of the market has mutated. Applying a generalist banking approach to these highly technical, state-backed manufacturing firms is now a structural liability. Looking at that 44% industrial pipeline data clarifies exactly why JPMorgan targeted Yi Zhang. Zhang spent 20 years at Goldman Sachs focused explicitly on manufacturing and industrial sector deals, perfectly matching the dominant source of current market volume. While rival banks deploy junior contract staff to handle due diligence, those temporary workers lack the deep, sector-specific relationships required to actually win the mandates from industrial executives. Furthermore, Zhang's specific background fits JPMorgan's strategy of capturing innovation economy companies early in their life cycle, advising them as they scale into large-cap global players. He provides the human capital necessary to build a strategic bridge between the mainland industrial base and global capital markets. Structurally, installing Zhang as a co-head serves as an institutional safeguard against the rule of man key person risk that is endemic to Chinese banking operations. By maintaining two senior leaders, the bank ensures that its entire regional deal pipeline does not vanish overnight if a single powerful executive departs for a competitor. This diagram maps the functional handshake between the two leaders. Michelle Wang commands local coverage and equity capital markets, while Yi Zhang delivers technical execution for complex industrial sectors. The final component of this leadership triad is the elevation of the former co-head, David Lau, to vice chair for the Asia-Pacific region. In this expanded role, Lau manages critical relationships with Hong Kong regulators and oversees the firm's highly profitable regional healthcare practice. This specific division of labor creates a diversity of mindsets within the leadership team, effectively blending local political acumen with international execution standards. This co-head model also aligns seamlessly with Confucian leadership ideals, prioritizing collective action and relational harmony, traits heavily favored by mainland corporate clients. Through this arrangement, JPMorgan has engineered a resilient triad, fully capable of absorbing sudden regulatory shocks and the mobility of high-level talent. This 2026 year-to-date M&A scorecard shows JPMorgan actively closing the gap in deal value against market leader Goldman Sachs at $223.6 billion compared to $320.7 billion. M&A stands for mergers and acquisitions, the financial consolidation of companies or assets. This growth is driven by the firm's integrated approach, using corporate banking and payments as early entry points to eventually secure the high-margin investment banking mandates from industrial tech firms. JPMorgan's aggressive hiring spree, executed precisely while its rivals contract, is a direct response to the macro-level shift dictated by the 15th five-year plan. As the 2026 to 2030 economic cycle begins, capital is rapidly following state policy into the high-tech manufacturing sector. To capture that capital, banks must deploy specialized talent. By monopolizing industrial sector expertise today, JPMorgan is aggressively positioning itself to own the China Shock 2.0 deal flow tomorrow. That's our analysis of the Asia-Pacific talent wars. If you want to understand the hidden mechanics driving global finance, make sure to subscribe to Wall Street Perspective, and we'll see you in the next breakdown.